Ladies and gentlemen, today's update centers on a measured discussion that has drawn attention across the dinar community, following recent commentary from Frank26 regarding possible future exchange rate scenarios, including figures such as a 4.48 level for the Iraqi dinar and a 3.67 reference for the Vietnamese dong, framed within broader RV expectations looking toward 2026. What is important here is not the numbers themselves, but the context in which they were discussed. These figures were presented as theoretical benchmarks tied to long-term monetary reform outcomes, not as immediate or guaranteed rate changes. From an analyst's standpoint, such commentary reflects ongoing evaluation of currency potential under specific economic and structural conditions, rather than a prediction of near-term execution. On the Iraqi side, monetary reform remains the central theme. Iraq continues to signal its intent to modernize its financial system through banking reforms, digitization initiatives, and stronger compliance with international financial standards. These steps are essential prerequisites for any sustainable exchange rate adjustment. The Central Bank of Iraq's focus on liquidity management, anti-money laundering controls, and gradual market stabilization supports the view that reform is methodical rather than rushed. Discussion around exchange centers opening should also be understood carefully. The activation or readiness of exchange infrastructure typically aligns with broader financial preparedness, including regulatory clarity and operational capacity. Such developments are not indicators of an overnight re-evaluation, but they do suggest that authorities are ensuring systems are in place to handle increased activity when conditions warrant. Globally, currency valuations are increasingly influenced by macroeconomic signals such as interest rate policy, energy markets, regional stability, and cross-border trade flows. Iraq's improving political coordination, rising non-oil revenue initiatives, and continued engagement with international partners contribute positively to investor sentiment, even as challenges remain. Investor confidence in the DNR today is driven less by speculation and more by patience, discipline, and attention to verified economic signals. While discussions of future rate potential can be informative, the responsible approach is to view them as part of a long-term framework tied to reform completion, economic resilience, and sustained financial stability. Asterisk the discussion presented by Frank26 regarding potential future exchange rate levels, including the 4.48 figure associated with the Iraqi dinar and the 3.67 reference connected to the Vietnamese dong, was framed as a conceptual outlook rather than a forecast tied to immediate market action. From a professional analytical standpoint, these values were introduced as part of a broader conversation about what could be mathematically and economically achievable if a full set of reform conditions were met over time. This type of dialogue is common in long-range currency analysis, where hypothetical benchmarks are used to illustrate valuation potential under idealized scenarios, not to suggest imminent execution or guaranteed outcomes. Frank26's commentary focused on structural alignment, emphasizing that exchange rate strength is ultimately derived from economic fundamentals such as asset backing, fiscal discipline, trade balance improvement, and monetary credibility. In the case of Iraq, any discussion of higher valuation assumes a successful transition away from reliance on cash-heavy practices, stronger enforcement of financial regulations, and a banking sector capable of supporting international settlement standards. Without these elements firmly in place, numerical projections remain academic rather than actionable. The inclusion of the dong in the discussion served as a comparative reference point within emerging market dynamics, illustrating how regional currencies may be evaluated when productivity growth, export performance, and capital inflows are factored into valuation models. It was not presented as a synchronized event or paired revaluation scenario, but rather as an example of how reform-driven economies can be analyzed within a global monetary framework. What seasoned investors often overlook is that analysts use numbers to describe potential ceilings, not time. The value of such discussions lies in understanding the conditions required to support those levels, not in assuming inevitability. By placing these figures within a 2026 horizon, the emphasis shifts toward patience, observation, and verification of progress rather than expectation of sudden change. In this context, Frank26's remarks align with a cautious, long-term analytical approach that acknowledges both opportunity and limitation. The dialogue underscores that any future movement toward higher exchange rates would be the result of deliberate policy execution, international confidence, and sustained economic performance, rather than speculative momentum or isolated announcements. Iraqi monetary reform continues to unfold as a structured and deliberate process, centered on strengthening the country's financial architecture rather than accelerating toward abrupt exchange rate changes. At the core of this effort is the Central Bank of Iraq's ongoing push to modernize the banking sector. reduce systemic risk, and align domestic practices with international financial standards. This includes tightening regulatory oversight, improving transparency within commercial banks, and reinforcing compliance with anti-money laundering and counter-terrorist financing frameworks, all of which are essential for restoring confidence in the national currency. A significant component of this reform involves transitioning the economy away from excessive cash usage. Iraq has taken incremental steps toward digital banking solutions, electronic payment platforms, and salary distribution reforms aimed at bringing more transactions into the formal financial system. These measures allow monetary authorities to better manage liquidity, monitor capital flows, and reduce distortion caused by parallel market activity. Over time, this level of control supports price stability and strengthens the credibility of the dinar both domestically and internationally. Regulatory compliance has also become a focal point in Iraq's reform narrative. Coordination with international institutions and correspondent banks requires consistent reporting standards, risk assessment protocols, and enforcement mechanisms. As Iraqi banks demonstrate improved governance and operational integrity, they become better positioned to re-engage with global financial networks. This gradual reintegration is a necessary condition for any meaningful discussion of exchange rate flexibility or adjustment. Stabilization efforts extend beyond the banking system into fiscal coordination and monetary policy alignment. The government's efforts to manage public spending, diversify revenue sources, and reduce dependence on oil price volatility directly influence the central bank's ability to maintain monetary balance. Political cooperation between fiscal authorities and monetary policymakers remains a key indicator closely watched by investors and institutions alike. Taken together, these reform elements illustrate that monetary change in Iraq is being built from the foundation upward. Exchange rates outcomes, whatever they may be in the future, are a byproduct of this process rather than its primary driver. The emphasis remains on durability, credibility, and institutional readiness as the reform path continues to evolve. The readiness of exchange centers is often cited in discussions surrounding currency reform. Yet from an analytical perspective, this development should be viewed as a logistical and regulatory milestone rather than a signal of immediate exchange rate action. Exchange centers function as the operational interface between monetary policy decisions and public participation, meaning their preparation is essential well before any policy shift is implemented. In Iraq's case, attention to exchange infrastructure reflects a broader effort to ensure that systems are compliant, monitored, and capable of handling increased transaction volume under a more structured financial environment. Opening or authorizing exchange centers involves a layered process that includes licensing, compliance verification, and integration with banking and payment networks. These entities must adhere to strict reporting requirements, identity verification protocols, and currency tracking standards designed to prevent market abuse and illicit activity. By focusing on these controls, authorities signal their intent to maintain order and stability, regardless of the pace or direction of future exchange rate adjustments. From a timing standpoint, exchange centers are typically positioned in advance of any major financial transition. Their readiness allows for smoother implementation of policy decisions whenever conditions align, reducing the risk of operational bottlenecks or public confusion. This preparatory phase can extend for months or even years, particularly in economies undergoing systemic reform, and should not be interpreted as confirmation that a revaluation decision has already been made. Another critical factor is public confidence. Well-regulated exchange centers help anchor trust in the financial system by offering transparent pricing, standardized procedures, and official oversight. This is especially important in markets where informal or parallel exchange activity has historically influenced currency perception. By strengthening formal exchange channels, authorities work to narrow market spreads and reinforce the legitimacy of official rates. International observers also view exchange center preparedness as part of a compliance narrative rather than a speculative signal. Correspondent banks, foreign investors, and regulatory bodies prioritize operational readiness and governance over speculation-driven time. The presence of compliant exchange infrastructure supports the broader objective of financial normalization and market discipline, creating a framework in which future policy changes can be absorbed responsibly and efficiently. Investor sentiment surrounding the Iraqi dinar is shaped by a convergence of political stability, macroeconomic indicators, and broader global economic signals rather than isolated commentary or short-term speculation. Market participants increasingly assess Iraq through the lens of risk management, looking for consistency in governance, continuity in policy, direction, and the ability of institutions to function independently and transparently. Periods of political alignment between the executive, legislative and monetary authorities tend to reduce uncertainty, which in turn supports a more constructive view of the currency's long-term prospects. Global economic conditions also play a significant role in shaping expectations. Interest rate trends among major central banks, shifts in energy demand, and fluctuations in commodity markets directly influence capital flows into emerging economies. For Iraq, oil revenue remains a dominant factor, but growing emphasis on no-oil sectors, infrastructure, investment, and regional trade partnerships has begun to alter how investors model future performance. These developments contribute to a more balanced assessment of sustainability rather than reliance on a single revenue stream. Financial stability indicators such as foreign reserve levels, inflation control, and exchange market management are closely monitored by institutional observers. The Central Bank of Iraq's ability to maintain reserves, manage currency auctions responsibly, and address parallel market pressures feeds directly into confidence metrics. When these indicators show consistency over time, they reinforce the perception that monetary authorities are capable of supporting gradual evolution in currency policy without destabilizing shocks. Investor behavior in the dinar space has also matured. A noticeable shift has occurred from emotionally driven expectations toward a more disciplined approach focused on verification and data. Participants increasingly track legislative developments, banking reform, milestones, and international engagement as signals of progress. This transition reflects a broader understanding that currency value appreciation is the outcome of sustained economic performance and credibility, not anticipation alone. Taken collectively, these factors create an environment where sentiment is cautiously constructive rather than exuberant. The dinar is evaluated within a long-term framework that weighs opportunity against risk, with confidence building incrementally as stability indicators align and global conditions remain supportive. Asterisks in this environment. Expectations remain grounded in realism, with experienced observers recognizing that meaningful currency strength emerges only when political cohesion, economic discipline, and global confidence intersect over time. As these elements continue to develop in parallel, sentiment evolves steadily, guided by evidence rather than assumption and by progress rather than projection.